Madness has now been extended through November 4th here at the Federal Reserve Pawn Shop. We bought almost $200 billion of new assets already to expand our balance sheet. Aren't we great? Up to $75 billion per day, with new lines of 14-day term limit borrowing too. Awesome! Bad collateral? No problem. Free pickup in hazmat or radiation suits of your toxic garbage. Mortgage-backed securities, toxic derivatives, CLOs, and toxic sausage. But please, no vegan sausage. We'll match any of Crazy Eddie's prices. We'll pay full price for the worst toxic garbage. We'll overpay. And coming soon, permanent Repo Madness. QE on demand and permanent QE.
So I recorded another parody for you guys of Repo Madness. The new Repo Madness announcement came out on October 4th on my birthday that Repo Madness would be extended through November 4th of 2019. So the Fed has out that they're going to buy at least $75 billion in aggregate amount of at least daily overnight repos for an aggregate amount of at least $75 billion each through Monday, November 4th, 2019. Securities eligible as collateral include US Treasuries, agency debt, and mortgage-backed securities. So here's the interesting part. Someone was sending me, because I've been asking, well, what is the Fed buying? So the only clue that we have that the Fed is actually buying, and this may not be honest about it, that the Fed is not telling us the truth, but on the New York Fed's website, there actually is a link here that tracks it. And some of these days, boys and girls, the Federal Reserve is buying an insane amount of mortgage-backed securities as collateral for Repo Madness. Let me take a look at some of these days. So on Thursday, September 26th, over $15 billion in mortgage-backed securities was used as collateral. On, let's see here. Also on Thursday, September 26th, another $29 billion in mortgage-backed securities was used as collateral. And let me scroll through here. Oh, wow. So on the 25th, on Wednesday, September 25th, $34 billion was used as collateral. Scroll down again. Deal date on Tuesday, September 24th, $20 billion, almost $21 billion was mortgage-backed securities was used as collateral. And on another term there was another $25 billion. So large billions of dollars amounts of mortgage-backed securities. But I thought the Fed was dumping mortgage-backed securities, and now they're buying them back. Interesting. So we don't know if that's actually true or not. This is all we know. This is the only halfway reliable information because there is no independent audits again. So if the Fed is buying mortgage-backed securities, I wonder which bank they're buying them from, or banks. Which bank or banks they're buying them from. This is live, Anthony. I did a parody commercial for the first 45 seconds. It was recorded and edited. It was in the Crazy Eddie, goofy used car salesman size. Style. So there's been two interesting, this show's going to be shorter because it's late at night, and I had a interesting birthday weekend. I don't want to go into the details because they're not safe for work. So, there was two very good articles that came out in the last couple days about this Repo Madness and it being extended. My friend Michael Leibowitz from realinvestmentadvice.com, he wrote an article calling it QE by another name, and he was citing a research report from a former Federal Reserve Bank upper management person. The article that he cited in there is from the Peterson Institute, and it's arguing for a permanent repo facility. So here, I'll just read part of the article. U.S. markets for short-term credit experienced several days of tumult in mid-September 2019 because, remember, Repo Madness officially, it became public on late Tuesday night, September 16th, and then the article started coming out on, I think, Wednesday, September 17th. But the Fed probably knew about this quite a bit sooner than we did. Probably potentially at least a week, maybe 2 weeks before it became public. As interest rates in the treasury market for repurchase agreements or repo soared and market participants fretted over a possible reduction in funding availability for their investment activities. All eyes turned to the Federal Reserve Bank of New York to restore order to the market, and it used its considerable operational firepower to do just that. Nevertheless, this episode indicates that the operational framework established by the Federal Reserve is not as resilient as it could be. In our view, the Fed should make several changes to help create a more resilient and effective operating system. The Treasury repo market, where banks and other financial institutions get short-term funding in exchange for Treasury collateral, and also other toxic garbage, may not be well understood by many people, but it is critically important to the U.S. financial system and the economy. More than $1 trillion in funds flow through it every day. Volatility in this market threatens the functioning of markets more broadly and could ultimately hurt the economy, even though the open market trading desk at the New York Fed was able to quell that volatility over a few days, relying on discretionary operational responses by the desk. By their open market trading desk allows market strains and uncertainty to persist to a degree that is unnecessary. Also, fourfold increases in the overnight repo rate, which is interesting because the banks decided that they didn't want to make that money loaning out their reserves. A better approach is needed. To be clear, the issue is not that the Fed chose the wrong type of operating regime, the so-called floor system, which leaves abundant liquidity in the financial system and relies on the Fed's ability to pay interest on those balances. So this is all the reserves. Interest on the balances has the capacity to provide highly effective control of overnight interest rates. Instead, the issue rests with specific choices about how the floor system has been implemented. We suggest several changes. So this article that I'm reading is from a former Federal Reserve employee who's writing this article for the Peterson Institute. My friend Michael Leibowitz cited it in his article, QE by another name. And I'm working on getting Michael Leibowitz on for an interview in the next week or two. First, the Fed should implement a standing fixed repo rate facility from which a set of counterparties, including banks, can borrow at a rate modestly above the rate of interest the Fed pays on excess reserves, IOER. The most important lesson from the recent episode is that even in a regime with ample reserves, unexpected developments can occur that put upward pressure on money market rates. A standing repo facility, first proposed by them in 2014, would provide a guardrail against those I didn't know anyone was actually proposing in 2014. I thought the earliest reference of it was in March of 2019 from the St. Louis Fed. So it would provide a guardrail against those unexpected developments. Recent Danielle DiMartino Booth, like I said in the parody, has called this permanent repo facility once it's implemented, and it could be implemented as early as the next Fed meeting here at the end of October, quote unquote QE on demand. A standing repo facility, recent events leave little doubt that a guardrail is needed. By relying on a standing facility, the Fed would make the operational response transparent, predictable, and forceful, which would in turn stabilize the behavior of market participants. Second, the Fed should aim for a higher level of reserves in general. I thought the banks already have a lot of reserves. I thought the reserves, the banks have record reserves. I thought the reserves the banks have, even though interest on excess reserves has been removed, I thought the banks have well over $1 trillion in reserves. And the Fed has done a good job of trying to prevent the banks from lending out those reserves, because that would increase the money velocity, lending and spending, and could potentially cause hyperinflation if there was increased velocity of money. So the Fed has been roping that off, keeping the reserves at the bank. However, at the Fed, so the large banks have been making enormous profits on interest on excess reserves. So have foreign banks, and I think even foreign central banks have reserves stocked at the Fed too. So they've been making interest on excess reserves as well. Okay, let me continue with the article. We are not making a simple inference from recent developments that aggregate reserves are too low. That conclusion would be premature until those developments are better understood. Oh, the other point I wanted to make, and I've discussed this at length with Nomi Prinz, who was very high up at Bear Stearns and Goldman Sachs. You can go back into the archives and listen to those interviews. I believe she's talked about it elsewhere as well, although I think I was one of the first to ask her these questions, is that those reserves that the large banks keep at the Fed, yes, they're earning interest on excess reserves, and no, they're not making a lot of loans inside the U.S. economy. There are other ways, other bets, other gambles, other speculations that those reserves could be used as collateral for other things. So the banks could have used that collateral of the reserves at the Fed for a bunch of other things to speculate on derivatives or other investments outside the United States or other gambles outside the United States. Okay, back to the article. Instead, we want to push back on the general notion that the Fed should identify some minimum level of reserves for the financial system. So the Fed already has massive reserves in place compared to the past. I think the initial reserves were tiny. I remember reading the initial reserves prior to 2008 were like 20 billion, and now they're over $1 trillion. So there's a lot more reserves in the system. Instead, we want to push back on the general notion that the Fed should identify some minimum level of reserves for the financial system and seek to get close to that level. The minimum level of reserves is conceptually murky, impossible to estimate, and likely to vary over time. The best approach is to steer well clear of it, especially since maintaining a higher level of reserves as a buffer has no meaningful cost. No meaningful cost except the banks speculate on assets and make lots of money on asset price inflation and push the value of assets up and fund unicorn IPOs and shale debt and other garbage. Okay, to that end, a case can be made for the Fed to increase the general level of reserves by $250 billion over the next 2 quarters through outright purchases of Treasury securities. Thereafter, the Fed should continue to grow its balance sheet as needed to expand reserves in line with nominal GDP. So they're saying that there's not enough reserves in the system. This is interesting. I've seen some investment banks calling for higher reserves too, saying that the reserves should go up to 1.8 trillion. I've seen estimates of even higher than that. Third, the Fed should be explicit about its desire to control the repo rate. Right now, they're manipulating and trying to manipulate the repo rate now too, because it's not enough to manipulate LIBOR. It's not enough to manipulate the federal funds rate. It's not enough to try to manipulate other interest rates. Now they have to manipulate the repo rate too. Right now, the directive that the Federal Open Market Committee, FOMC, gives to the New York Fed trading desk is specified in terms of the federal funds rate, with instructions to conduct operations only as needed to keep this rate within its target range. But the federal funds market is much smaller and less important than the repo market, so this directive is dangerously inadequate. For example, the FOMC directive would suggest that last week's money market conditions were largely acceptable. The desk missed the target range on only one day and by only a small amount, which would be an absurd perspective. It is important for the Fed to control the repo rate, and the FOMC directive should explicitly state that. In fact, the Fed should consider even going as far as adopting the repo rate as measured by the Secured Overnight Financing Rate as the targeted policy instrument. Fourth, the Fed should ensure that the bottom end of the interest rate target range is strong, so they have to manipulate things into a range, even though to prevent the repo rate from going up fourfold. But if the market was acting better, then the banks would have actually made those loans and the rate would have come down faster instead of the Fed doing more intervention. The better question is, why didn't those banks with massive amounts of reserves want to earn 2% or more when the overnight repo rate spiked fourfold? Why didn't they want to earn that just for an overnight loan? Why didn't they want to earn 10% for an overnight loan? Interesting. I don't know if we're ever going to get an answer on that. Even though this aspect of the framework is not, because the Fed does not want us to know which specific banks are having which specific problems. So everyone knows about Deutsche Bank and some of the other European banks, but they don't want us knowing any more about all the specific problems at banks. It may eventually come out, but they don't want it. They don't want it coming out. Even though because then that bank will be targeted by short sellers, and then that will create more counterparty risk. And at some point, they can change the rules and maybe ban short selling on bank stocks. Didn't that already happen in 2008? It happened for some short selling, I believe. This aspect of the framework is not a pressing issue today. The Fed should be prepared for when market conditions change. The recent decision to bring the reverse repo facility rate, the rate that provides the strongest floor of market rates, below the bottom end of the target range was puzzling, and it could become problematic for the Fed when market rates soften. The strongest and most equitable policy approach would be to set both the RRP rate and IOER at the bottom of the range. The lesson from this episode is that unexpected circumstances can arise abruptly at any moment. It is therefore crucial to design a monetary policy system that stands up to the unexpected. Actually, if you wanted an anti-fragile system, there shouldn't be a central bank at all. And then the banks would be a lot more cautious. But instead, we have the central banks just, coddling the banks and moral hazard. And all this market manipulation that the bankers do, almost none of the bankers go to jail. They pay a fine. They don't even pay a fine with their own money. They pay a fine with shareholder money. The 4 changes suggested here would create a more resilient and effective operating system for the Fed. Let me see what Michael Leibowitz has to say about this. So Michael Leibowitz says these former Fed officials do not realize that the policies they helped create and implement were a big contributor to the financial crisis a decade ago. The ensuing problems the financial system is now enduring are a result of the policies they implemented to address the crisis. Their proposed solutions, regardless of what they call them, are more imprudent policies to address problems caused by imprudent policies since the financial crisis. And he's talking about how if it walks like a duck and quacks like a duck, it basically is QE. So to help you form your own opinion, let's look at some facts about QE and balance sheet, about quantitative easing program and balance sheet increases prior to the QE era. From January of 2003 to December of 2007, the Fed's balance sheet steadily increased by $150 billion, or about $30 billion a year. That doesn't seem very much now. Maybe back then it did, but that seems like nothing. In fact, that might be going forward, that might be the Fed's balance sheet may be increasing by less than that per day. In fact, in the last 5 weeks, with the Fed's balance sheet increase, it's almost to those levels. It was, in 5 weeks, it was increased by around 180 billion. 188 billion, I think, is the exact number. So the new proposal from these 2 guys who wrote the paper for a 250 billion increase over 6 months. The QE1 program lasted 6 months and increased the Fed's balance sheet by 265 billion. So they're talking, this is how crazy everything is getting. They're proposing a balance sheet increase of 250 billion over 6 months, and all of QE1 first QE1 lasted 6 months and increased the Fed's balance sheet by 265 billion. So it appears to be, if it walks like a duck and quacks like a duck, appears to be similar to QE. So this permanent repo facility is not going to be called QE. It's going to be intentionally rebranded, as the marketing guys like to say. And my buddy Daniel Lacaille also wrote a excellent article that I was reading earlier today. It came out, well, now it's not today. It came out yesterday on Sunday, October 6th. The repo market incident may be the tip of the iceberg. So the Federal Reserve has injected $278 billion into the securities repurchase market for the first time. Numerous justifications have been provided to explain why this has happened, and more importantly, why it lasted for various days. The first explanation was quite simplistic. An unexpected tax payment. This made no sense. I agree with Daniel, that was total bullshit. If there is ample liquidity and investors are happy to take financing positions at negative rates all over the world, the abrupt rise in repo rates would simply vanish in a few hours because people would want to earn the higher interest rate. Okay, just taking a quick water break there. Let us start with definitions. The repo market is where borrowers seeking cash offer lenders collateral in the form of safe securities. And I guess it's a very subjective definition of what is quote-unquote safe, especially now if the Fed is taking many billions of mortgage-backed securities. At least that's what the New York Federal Reserve website is claiming. Thank you. Hat tip to my listener who sent me this. I will put a link to this that it updates daily. So if you want to take a look at this for yourself, you will be able to monitor this. Okay, back to the Daniel Lacaille article. The repo market is where borrowers seeking cash offer lenders collateral in the form of safe securities. Repo rates are the interest rate paid to borrow cash in exchange for treasuries for 24 hours. Sudden bursts in the repo lending market are not unusual. What is unusual is that it takes days to normalize, and even more unusual to see that the Federal Reserve needs to inject hundreds of billions in a few days to offset the unstoppable rise in short-term rates. Because liquidity is ample, thirst for yield is enormous, and financial players are financially more solvent than years ago, right? And he says wrong. What the repo market crisis shows us is that liquidity is substantially lower than what the Federal Reserve believes, that fear of contagion and rising risk are evident in the weakest link of the financial repression machine, the overnight market, and more importantly, that liquidity providers probably have significantly more leverage than many expected. In summary, the ongoing and likely to return burst in the repo market is telling us that risk and debt accumulation are much higher than estimated. Central banks believed they could create a tsunami of liquidity and manage the waves. However, like those children's toys where you press one block and another one rises, the repo market is showing us a symptom of debt saturation and massive risk accumulation. When did hedge funds and other liquidity providers stop accepting treasuries for short-term operations? It is easy money. You get a safe asset, provide cash to borrowers, and take a few points above and beyond the market rate. Should be easy money. Are we not living in a world of thirst for yield and massive liquidity, willing to lend at almost any rate? Well, it would be easy money unless all the chain in the exchange process is manipulated and rates too low for those operators to accept even more risk. So in essence, what the repo issue is telling us is that the Fed cannot make magic. The central planners believe the Fed could create just the right inflation, manage the yield curve while remaining behind it, provide enough liquidity, but not too much, while nudging investors to long-term security. So like Goldilocks, pressing of levers in the Keynesian, neo-Keynesian mold. And basically the repo crisis is a crisis. Okay, let me reread that. Basically, the repo crisis, because it is a crisis, is telling us that liquidity providers are aware that the price of money, the assets used as collateral, and the borrower's ability to repay are all artificially manipulated. That the safe asset is not as safe in a recession or global slowdown, that the price of money set by the Fed is incoherent with the reality of the risk and inflation in the economy, and that the liquidity providers cannot accept any more quote-unquote safe assets, even in higher rates, because the rates are not close to enough, which is surprising considering the spike to 10%. The asset is not even close to be safe, and the debt and the risk accumulated in other positions in our portfolio is too high and rising. The repo market could have been justified if it had lasted one day. However, it has taken a disguised quantitative easing purchase program to mildly contain it. This is a symptom of a larger... So my buddy Daniel Lacaille called this a quote-unquote disguised quantitative easing purchase program. This is a symptom of a larger problem that is starting to manifest in apparently unconnected events, like the failed auctions of negative yielding Eurozone bonds or the bankruptcy of companies that barely needed the equivalent of one day of repo market injection to finance the working capital of another. So these are zombie companies. My buddy Daniel Lacaille has been talking about zombie companies for the last couple years, how it's getting worse, especially in Europe. And now with CLOs, collateralized loan obligations, go back into the archives from a couple months ago and look up my CLO episode. This is a symptom, and the Japanese banks are supposedly heavily involved in CLOs as well. The Bank of International Settlements was warning about it. This is a symptom of debt saturation and massive risk accumulation. The evidence of the possibility of a major global slowdown, even a synchronized recession, is showing that what financial institutions and investors have hoarded in recent years, high risk, low return assets, is more dangerous than many of us believed. It is very likely that the Fed injections become a norm, not an anomaly, and the Fed's balance sheet is already rising. It is already rising, and it looks like it's not going to stop, but we'll have to monitor that. Thankfully, I'm making some money doing these updates and podcasts, so I can continue to monitor that and keep you guys informed with the links, and be linked from the New York Fed, where they post their daily open market purchase operations, what is collateral each day for their repo loans, that you can monitor that if you want to as well. So China is a problem. Injections are a symptom of much more dangerous problems in the economy. The destruction of the credit mechanism through constant manipulation of rates and liquidity has created a much larger bubble than any of us can imagine. He's talking about China, how China's an enormous bubble, and the zombification of the economy, and proof that unconventional monetary measures, which are now, quote, becoming conventional, as the Fed is now calling QE, quote unquote, conventional now, according to Danielle DiMartino Booth, have created much larger imbalances than the central planners expected. The repo crisis tells us one thing: the collateral damages of excess liquidity include the destruction of the credit transmission mechanism, disguising the real assessment of risk, and more importantly, leads to a synchronized excess in debt that will not be solved by lower rates and more liquidity injections. But that's what the Fed's going to do anyway. Many want to tell us that this episode is temporary. It has happened in the most advanced, diversified, and competitive financial market. Now imagine if it happens in the European Union, for example. This is like the inverted yield curve and the massive rise in negative yielding bonds, the tip of a truly scary iceberg, according to Daniel Lacaille. If you want to read that article for yourself, the link will be in the information and description section, as all my other sources are. So I'll take a look at listener questions and comments now. Hopefully my voice will not totally crap out. I did go out last night with my sister and a couple other friends for my birthday, and I did have a couple drinks. That was a rarity for me. I don't drink that much anymore. Normally on a weekend or a Friday or Saturday night, it is one beer normally on a Friday night and one beer on a Saturday night, and that is it. And I don't drink during the week. I am a responsible adult, unlike the troll that was calling me an alcoholic. So, let's go to the super chats first. So, thank you, Greg, for the super chat. I appreciate it. Thank you, Dimitri, for the super chat. Thank you, David, for the super chat. And thank you, Saurabh Sharma. And thank you, TL. Much appreciated for your super chats. Wow, a lot of people watching today. Almost 300 people. Pretty damn good at after midnight on the East Coast. Must be doing something halfway decent. Even though YouTube has just decided that they will not allow me to add another 100 subscribers. I was adding 2,000 new subscribers per month, and in the last month they took it down to 0. Anyways, I'm still making money doing this. I'm still scratching out a living doing this now after a lot of hard work. So as long as I'm doing that, and as long as my Patreon account contributors are growing and people are still chipping in, the good content will continue. I sent out emails to other interview guests, so we'll see what we can get this week. I make no promises. Sometimes things just don't work out with certain guests. I am still trying for Kyle Bass, though. Okay, so let me take a look at these super chat questions. Dimitri asks, could all this repo madness come as a result of loss of confidence in U.S. banks? SoftBank and WeWork. So Goldman Sachs, from what I've seen with the WeWork stuff, I was going to include this in a real estate show. Goldman Sachs has losses on the WeWork, the fact that they didn't dump it on the IPO. So there are some investment banks with losses, but they're not in the billions. I think Goldman Sachs officially has around $250 million in losses. SoftBank, from what Kyle Bass was saying, SoftBank borrowed $50 billion from the Saudis and has guarantees. So the people at SoftBank may be in some trouble with the Saudis. So I'm not sure if this is going to affect U.S. banks as much. With the SoftBank and WeWork stuff, I don't think the losses are in the tens of billions. It sounds like the people on the hook are Silicon Valley, whichever real estate markets WeWork overpaid for real estate. WeWork's a disaster. And the other main player is the Saudis and Japanese because they put a lot of money into SoftBank. And it sounds like there was a lot of scams with SoftBank to do small capital raisings at higher valuations to try to trick people and move the valuation up at different levels. With the angel investors, private equity, those guys, venture capitalists. It's a common Silicon Valley trick. So they do small capital raises at a higher valuation to try to trick people that the value of the company is going up when the underlying operating fundamentals are actually getting worse. So no, I don't think Repo Madness is coming as a result of loss of confidence in U.S. banks because U.S. banks were recapitalized more than European banks. This could be, we don't know how much European banks are involved with American subsidiaries in getting involved in Repo Madness. So this could be that American banks don't trust American subsidiaries of European banks. It could be a mix of things. The Fed, okay, Dimitri, the Fed does not want us knowing which specific banks have the worst problems. Okay, on to David Dalton. That's my opinion. Did you say there was info about the collateral that's been posted by the banks for the repurchase operations on the New York Fed website? Can I provide a link? Yes, I will put the link in the live chat section, and thank you for the super chat, David. The link will be in the live chat section so you can monitor this daily. The link will also be in the information and description section after this video is over. Okay, that should work. Let me click on it and see if it worked. Yep, there we go. There you have it. It's updated as of Friday, October 4th. So now you guys can monitor it too. Just put it in the live chat there, the link. Okay, thank you for the super chat. Oh, a couple more. A couple more from BB FreeTube and Jonas. Thank you. So Repo Madness is not going away. The Fed realizes there's problems. They don't want us knowing which banks, because once they know once it's released in public which banks have the most problems, then what's going to happen is those banks would come under attack from short sellers. And then those other banks that had the most counterparty risk to the banks that are in the most trouble, then those banks would be attacked by short sellers. Do you see? And this is why the Fed doesn't want transparency. The Fed does not want these banks' shares to be attacked by short sellers, because then that could create even more problems. You could potentially see, if it came out, this is hypothetical, so if it came out that HSBC Bank was the one who, with their American subsidiaries, had all these problems and was selling the mortgage-backed securities and some of these other things, along with their other problems, then, and I'm not saying it is HSBC, this is hypothetical. So if it was HSBC Bank, then their shares would come under attack, the share price could collapse, and all their other banking counterparties that had the most loans or trades or derivatives exposure to them would also become under attack. So this is why the Fed is trying to prevent it from coming out which banks are tapping the repo market the most. They want to keep it a guessing game, so no one knows exactly which banks are in the most trouble. It's not as obvious as it was prior to 2008 with Bear Stearns and Lehman Brothers and Washington Mutual and Wachovia and IndyMac. Everyone knew that those banks had the most leverage and the most problems. Those banks had the worst balance sheets. The leverage ratios were even worse. Yeah, the link works. I checked it. You're welcome. When do I think all this new Repo Madness money will start affecting Main Street? It's a good question. I don't think it will affect Main Street that much, because the real economy in the U.S. is already headed towards a recession, and depending upon which state and city and county you live, your taxes are already being increased. So the U.S. economy is already in stagflate and tax and lie mode, and it's only going to get worse, Repo Madness or not. Now, if things get bad enough, then other companies and other industries could start to fire people and lose jobs. I think the largest job loss is coming right now from retail. There's a lot of job losses in retail. That benefits the consumer. There's more deals online for e-commerce. Free shipping, free returns, other sales. The retailer actually cuts their costs not having all those bricks and mortar retail stores and just having a warehouse. So they cut their costs a lot, and they can offer the consumer more deals. But there's less jobs for human beings then. And I think if I'm right, in the next couple of years and the shale oil industry has a big bust, if the oil price keeps getting weaker, there's going to be a big bust in shale. And that's going to be a lot of job losses. And then there's going to be a bunch of restaurants and shopping centers around the shale oil areas. Those are going to get badly hurt too. Okay, I'm looking through listener questions and comments here in the live chat. Repo bedtime story. Well, they're supposedly replacing LIBOR. They're replacing it with something else soon. A new thing to manipulate, a new toy for the banks to manipulate. Citibank released, Marcelo asked Jason, Citibank released a note a few weeks ago that they expect gold to be around 2,000 per ounce level at the end of 2020. Do you think this is likely and realistic? It's possible. The manipulation in the gold price normally would not allow gold to 2,000 that quickly, but it's possible. I wouldn't be buying out of the money call options on GLD, betting on that, or on the gold price. I wouldn't be buying futures options on futures and options on the gold price, betting on that. Not in that time frame. But I think 2020, probably by the end of the year, I think the gold correction that we've had recently in dollar price gold, I think that correction will be over by the end of this year, by the end of 2020, by the end of 2019, and 2020 will be good for gold. Very good. So if gold is at 1,700 or 1,800 by the end of 2020, I think that's a good year. Other people will still be pissed, but I think that would be a good year. Look, I'm just worried because the gold miners are not getting funding. So even though the gold price is going up, a lot of these gold miners, they're operationally improving. They have some better margins, but things were so bad for so long, for the last 7 or 8 years, that a lot of these gold miners, that a higher gold price since April and May is not going to solve their problems. That's the problem. Yeah, so I would not be buying, not financial advice, just my opinion, I would not be buying call options on 2,000 gold by the end of 2020. The manipulators, gold's eventually going to go to 2,000, just I don't know if it's going to be at the end of 2020. But I think the gold bull market has restarted, and I think there is a lot of smart money, management money, a lot of smart professional money managers that are not gold bugs, that are now either publicly admitting that they're buying gold on every dip, like Sam Zell and Jim Bianco and Mark Mobius. They're admitting they're buying gold on every dip, and they're not gold bugs. Or they're actually not admitting it publicly, and they're actually buying gold on every dip. So I think there's a lot of professional money managers that will go on CNBC and Bloomberg and will talk up stocks or bonds because that's the money they're managing, the assets under management, and then with their own money, they're buying gold. Because they're looking at all the data, the global macro data, and they're getting really worried. And once the U.S. enters an official recession, even though we know the real reality of the real economy here in the U.S., that things are very bad and getting worse. But once the U.S. enters an official recession, then things could get much, much worse very quickly. People who want to trade a lot of leverage by like futures and options on futures, I don't mess with that stuff. I don't mess with the papers futures market. I don't buy options on futures. A lot of the people who manage money or traders don't hedge those positions, and they could get in trouble. Yeah, smart money's accumulating gold. Foreign central banks are accumulating gold. I think there's a lot of professional money managers that will publicly not discuss that they're buying gold, but are actually buying gold. And if you're at like a dinner party with some of these guys, like off the record with other money managers, like at a poker game or at a charity event with alcohol, I think they would admit that they're buying gold, but they're not going to go on CNBC and Bloomberg and say that I've dumped all my stocks and I'm buying gold. Most people would not say that. The wealth effect? Oh, I think the Chinese government has been manipulating all the cryptocurrency prices down. Because remember, they as early as November 11th, they could be rolling out their government cryptocurrency, their digital RMB. So I think to dissuade Chinese citizens from either holding their Bitcoin and cryptocurrency and buying more, I think they've been manipulating it down. I mean, the new normal now that we have is large banks and other large entities and governments and central banks want to manipulate interest rates. They want to manipulate their exchange rates. They want to manipulate commodities. The Saudis tried to kill shale oil from 2013 to 2016. The Saudis blew through a ton of their reserves trying to do it. They had some big budget deficits those years, and they blew through a lot of their reserves, allowing the oil price to go lower, because they thought that they were going to bankrupt shale oil when oil went below 65, and it didn't work. They got some bankruptcies, but they thought they would kill the whole thing, and it didn't work out. And the Saudis blew through a lot of it. So the Saudis did attempt to manipulate the oil price and kill shale then, and it didn't work out. Okay, well, there's a lot of other questions coming in, and my voice is starting to go. So I want to thank everyone for listening to the podcast. And if you missed the opening parody, I spent a good amount of time. It took me some tries because I'm tired from this weekend. It's been a rough birthday weekend with a few not safe for work stories, which I can't go into, unfortunately, because I don't want to get the podcast demonetized. Maybe I'll tell my friends in person this stuff. But thank you, everyone, for listening. Thank you for my 150 Patreon account contributors. Thank you for my almost a dozen monthly PayPal contributors. Thank you to the people who tip me once in a while. It's much appreciated. It's taken a lot of stress out of my life and allowing me to focus on good content, good analysis, good short videos, good interview guests. I'm doing a lot of the editing myself now in a lot of these interviews. I've learned how to do pretty decent editing on these interviews. Although I am always looking for new talent for that if anyone wants to email me. And, if there's any graphic designers out there, I should come up with a new Repo Madness. That would be fun to come up with like a new Repo Madness flyer. Ryan, I did not waste my money like that at a strip club. That's all I will say. But a gentleman does not kiss and tell. Okay, so thank you, everyone, and I hope you enjoyed this unique content. And definitely go back and listen to the parody Repo Madness commercial, the new one I made, for the first 45 seconds if you missed it live. Okay, bye for now.